So a call spread is just a pretty simple idea. So you take some option, let's say Sava, 30 calls, and you take the 35 calls. And the 30 calls will be more expensive than the 35 calls because they're more in the money, no matter what the price of the stock is. The price could be 2. The 30 calls will always be more expensive. But let's assume it's at 30 and the price is, I don't know, say $3. And it doesn't matter what strike or what expiry it is. So let's say the 35 calls are $1. This is a call spread. So this call spread, if you buy it, costs $2 because you have to pay 3, and by selling something you get cash, right? So this is a debit of $2. You could also sell this spread, in which case the numbers are reversed, and you pick up $2. So it's up to you whether you want to buy the call spread or short the call spread. Just like doing it without the other arm, buying it means you're going long and shorting it means you're going short. So if you're shorting this call spread, you'll get a net credit of $2 and you hope the stock goes down. If you're long the call spread, you have a net debit of $2 and you hope the stock goes up. So it's pretty simple from that perspective. So why is this interesting? Well, let's say the stock, let's do some scenarios. Let's say the stock goes to 2. Let's say it's trading exactly at 30 right now. If the stock goes to 2, and we're going to assume you're long the call spread, but just know that everything I said, you can do the opposite. So let's assume we're long this. So where do our 30 calls go? Well, they're worthless, right? So we lose, if we're long, we lose the $3 we put down. And we gain the $1 from the short call. These calls are worthless too, but we were short them. So call spreads allow you to bound your risk and still use options to make the trade. So in this case, we lose $2. We lose the entire amount we had to put up because all the options are worthless. Okay, what about at I don't know, 29? So really the same story, right? All of these calls are worthless. Only after 30 do the calls start being worth something. So let's say at 33, what happens? Well, at 33, the 33 call, a 30 call is worth $3, right? So we actually broke even here. Our 30 call we bought for $3 and it's worth $3. We could exercise and it's a wash. The 35 call we sold is worth nothing. So we made $1 selling that call. So we make $1 in this scenario. What happens at 35? Well, this is kind of the optimal and also the peak scenario, where at 35, this call is worth, what, $5? It cost us 3, so we make 2 here. The 35 call is actually worth nothing, right? Because it's at 35. You would not pay for the right to buy something at 35. You could just buy it at 35. So you make $1 here. So you're now up 3. You're up $3 in this scenario. So the call spread, as the price goes up, your profit goes up. What about at 40? Well, at 40, the right to buy stock at 30 is worth $10, but you paid 3, so you only make 7. And that'd be great if you knew that was going to happen. You wouldn't even bother with the spread part. You would just buy the calls, but you don't know that's going to happen, so this is a bit of a hedge. And you're short 35 calls. Well, at 40, 35 calls worth $5, and you shorted it for 1, so you've lost $4. So your payout is now capped at 3. So if you look at the chart of the payout of buying the call spread, it basically looks something like this. It's capped. It goes up to a certain amount. There's a small linear amount, and then it's capped again. And one of these is sort of break even. So break even's kind of like here somewhere. And this is usually the strike price. So depending on how much separation there is between these, you'll find that these calls will be very flat, even as the price of the contract goes up. So instead of it being -3 plus 1, it'll be something like -3 plus 2.50, and you can only make 50 cents out of that $5 spread. So it's like very tight. So anyway, just a little something about options. You could sell one of these two. The reason you would do this sometimes is with margin, if you've capped your downside using options instruments, the broker will let you do a lot more stock. And that's the case with a lot of brokers. They'll let you go to town. Yeah, coin's going to have some competition to some extent. You could do it all over the place. I mean, obviously, if there's an implicit long ball